silver in a dangerous world? Yeah, that's why you own gold, silver. Yeah, that's why you have it. Um, you have to understand again the ebb and flow of silver prices, and there are a lot of people who are extremely fearful of things that they need not fear. Um, and I don't know how you get around that. Obviously, and we've said this our entire lives, you should have some of your assets in gold and silver. Uh, and you should not necessarily have 50% of your assets in gold or silver, but you should have some. Some paper silver is good, especially for investments. Some of our best performing investor clients have a long-term insurance holding of physical gold and silver, maybe in 2 or 3 different locations, maybe more. And then they have trading positions or buckets, which will include physical metal to some extent, but more often have to do with options or futures or forwards or ETFs or other structured derivative products. And they'll trade those things back and forth, taking advantage of the ebb and flow of prices while still having that base metal. When the price of silver got up to $50 in April of 2011, we were telling our clients, we think it peaks at the end of April and comes off sharply. We thought it would come back to $36 over the course of May. And as I said, it went down to 32, I think within the first week of May, once the May roll of the COMEX position was over. We had clients who sold their silver at $48 an ounce and bought it back a week later at $35 or $32 an ounce. We had clients who kept their silver but bought options and sold them back a week later and picked up another $8 an ounce. And then we had at least one client who said, no, I heard on the internet that it's going to 100. And he still owns his silver as far as I know. Stopped being our client. The first 2 guys made money. Bill Butler, I don't know who he is. Long-held belief of silver and banks warehouse storage manipulations. No, first off, the first thing you have to understand, bullion trading banks own silver. They're long silver. They lease it out to various manufacturers and others who want to borrow silver. They earn a percentage of the value. They have economic incentives to see higher silver prices. They do not have an economic advantage in seeing lower prices. If somebody was stupid enough to sue them and take them to a court of law, the first thing is what's our motive? We have an economic disadvantage to lower prices. We have an economic advantage to higher prices. Now, within the context of that, in the context of a complex global financial market that has inventories that are now reported in London since 2016 and have been reported in the United States since the 50s, since, gold started in the 70s. Boom. There are people who are in the business of being financial intermediaries in gold and silver. We're talking silver here. Banks, trading companies, brokers, and they are always sourcing metal. And it's not unusual to see companies mine the COMEX inventories, take delivery of the metal, see what I get. If it's the quality and brands that my clients want, I keep it. I take delivery. If it's not, I return it to registered stocks the next day and I sell it back. So there are people who will mine the inventories. It's not a matter of manipulation. It's a matter of trying to find good quality silver. of the brands and qualities that one's clients like. There are other companies. If I'm a banker or trading company and I'm providing hedges to producers, and let's say that the price of silver is $20, $22. Let's say the price of silver is $22, and I've done a hedge, a 6-month hedge for a producer. And 6 months later, 5 months later, the price is $22. Now, when I do that, I lock in that price, right? So I have said to a producer, the price is $22 today. The future price in 6 months is $22.50, say. Let's make it easy, $23. I will buy silver from you $23 in 6 months' time. That trading entity, whether it's a bank or a dealer, hedges that by going short silver at $23 an ounce in 6 months. So that's where that short position, like I'm protecting myself. If the price of silver goes to $22 or $20, and I've agreed to buy it at $23, I've just lost $3 an ounce. But if I've agreed to buy it at $23 and I've agreed to sell it at $23 and the price goes to $20, I haven't lost $3 an ounce. That's hedging. Now, you will notice that that bank did not borrow physical silver in the spot today, T-Day, and sell it to hedge its exposure in 6 months. It bought a future or an option or a forward, or sometimes options on ETFs nowadays, to hedge its exposure. There was no physical silver involved in that forward. Put it bluntly, forward sales by producers do not increase spot silver physical supplies. So if you see spot silver physical supply data with futures in it, you can throw hedging in it, you can throw the report away because that person clearly doesn't know how the market works or has ulterior motives or persisting in misrepresenting. Now, back to my price goes to 23, you sell it. Now, you go back to your producer and say, hey, the price has gone nowhere. It's $22.50 today. Do you want to do another 6 months hedge? And the producer says, no, it's like the market's flat. Okay, maybe if I saw $26, I'd do another 6 months hedge. Okay, so now I'm a bank or a dealer, and I've got $23 hedge in place. I'm going to be buying at 23. I'm going to be selling at 23. That's fine. I've got my profits locked in the margin there. That's cool. But I've got no hedge to pay my salaries in the next 6 months. So if I let myself get squeezed, if I hold that position in that 6 month forward into the delivery process, and people who don't know what is going on in the market sees this large open interest in the actively traded month, and they say, oh my God, this guy, he must not have the metal. They start buying silver, and it spikes up to $26. The dealer calls his producer and says, hey, you said you'd hedge at $26. You still interested? Sure, let's hedge at $26 for the next 6 months. And he's just made another hedge transaction, which is a hell of a lot more profitable than trying to trade the market. So there are people who have a vested interest in allowing themselves to be squeezed, if you want to use that term, for allowing people who don't understand what's going on to say, oh, these guys have this big short position on the COMEX that's going to blow up and the price is going to skyrocket. Let's go buy some metal, only to be disappointed later, but allowing that dealer to stay in business because he's doing more hedging. So if you want to call that a manipulation, and it's not a manipulation of the market. It's a manipulation of uninformed people who participate, if you will. Things like that happen all the time, not just in silver, in every financial market. Now, I can wait. I can sell you this today, but if I wait a week, I probably will be able to sell it to you at a much higher price. So you see stuff like that. I don't know if that helps or not. Are silver and commodities on the cusp of a run-up in prices? Most believe we are on the cusp. First off, I take exception with most. Yeah, most true believers who really don't study the market might believe that. Now, that said, CPM Group says, looking at the fundamentals of many commodities, not all commodities, uranium has already made that run up, and we think that the uranium market is oversold. And we have a very strong view about why we think that, which I won't. Copper has already had a big run up, and it's struggling to go there. We think that in 5 years, maybe copper has another run up, but in the interim, we could see some pullback. We always like a rifle shot as opposed to a shotgun shot toward this. So we look at the overall economy in the world and where we're going, and we have this macro top-down view, and that informs that informs our views across the market. But then we have a microeconomic view of supply, demand, other factors for each metal or commodity, because we do oil and gas and agricultural commodities too. We have a microeconomic view that informs that particular commodities view. So we look at it on a rifle shot basis. That said, yes, there are times when inflation is 14% and the world's going into the deepest recession, as was the case in 1979, and everything rises. And then it all comes back down. There are times, 2007 to 2009 recession, global financial crisis, followed by the sovereign debt crisis and treasury crisis in 2010, 2011. Everything kind of goes up and then it comes slamming down. And then it goes back up and then it comes slamming down. We can see that again. Laws are very worrisome to us because there's a lot of regulations that have been being put in place in the United States, in Canada, in the UK, in the EU, and elsewhere. And these can have unintended consequences. We've seen this before, and we'll see it again, where regulators say, well, there are risks of misfeasance and malfeasance in certain ways, and we need to put in regulations to protect the markets against that. And then the bankers and brokers and dealers and financial analysts come back and say, no, those regulations would, throw us into a recession because we can't loan money given those regulations. Regulations are important, and there's been some changes that are very worrisome to us. Taxes are important, as are a range of other government rents that are not overt taxes, but they suck money out of the private sector. Dollar dominance, I think, is a positive, and it doesn't necessarily preclude spikes up in metals and commodities. Mining is an industry that needs a lot of work and needs to understand that there are structural changes in the capital markets that severely reduce the capital flows through equity into mining. And we have to worry about private equity, which is not here. I have many concerns about the way many private equity companies operate. Interest rates, obviously, problem. But interest rates, even though they've gone up 5% in the last 2 years, they are still at the low end of the range of rates that you saw from, say, 1970 through 2010, 2011. So interest rates have a lot of industrial demand, very important. International affairs, really very important. Trade is very highly correlated with overall economic activity, and trade has been constrained by resource nationalism, increased international political tensions, increased nationalism, tribalism, or I guess people like to call it nativism, except that the anti-native in the United States, and a lot of other factors. So all of those factors are in there, and it's very difficult. How would these differences impact silver's pricing available? We think that the price of silver can rise. It can rise to a new record intraday price, and it can rise to a new record annual average price. We had it rising to a new annual average price in our projections for 25-26 until the last 6 months or so, when the economic environment has shifted to the better for the world, which we think reduces the concerns. But I would take exception with most. I think most people are relatively content with the economic situation as it now exists. Everybody always wants more. Quote that new country western song, everybody wants a bigger house. Or as I was told when I studied at J. Aaron, never show that you are satisfied with the size of your bonus. Always let them know you thought it should have been bigger. But I think that there has been in the last 6 months a reduction of economic concerns. I think that that can dissipate over the next 9 months. In fact, I expect it to, at which point I think silver and other commodities might rise. Deep dive in silver commodity? No, we sort of did that. I mean, our deep dives, we were once hired by a government to come down and spend a week talking about coal, oil, gold, mining, and we did. That's a deep dive. This was a deep dive. I mean, we're on to 2 hours now, so probably want to start thinking about wrapping this down. I'm going to ask Carlos about questions in a second. What's the outlook for futures of PGM markets and prices, and why are they being dumped? I think the outlook is that palladium in particular, palladium and rhodium, are well supplied. They're not in deficits. There's ample metal there. There's a shift away from them in auto catalysts to some extent. And there's a shift away from petroleum-powered vehicles to some extent. And that's all weighed heavily on palladium. And you've had a lot of investors who are long-term physical investors as well as futures investors who have started to back away from that. Platinum has a somewhat better outlook. But I think on a short-term basis, you've got a lot of investors who have just sort of soured on the platinum, palladium, rhodium story and the auto catalyst, and there's a lot of concern. We think it's misplaced, and it's starting to become apparent that other people are starting to think that it's misplaced. There's been all this talk about 50% of the vehicles being made and sold by 2030 would be electric, and 100% by 2035. And we've been saying for years that is physically impossible. There's just not enough raw materials, manufacturing capacity, not enough motor manufacturing capacity, controller manufacturing, capital availability to make that happen, let alone electricity and stable enough grids, and the realization that with electric vehicles, you're not reducing greenhouse gas emissions. You're simply replacing them from the tailpipe to the place where you're burning the coal and heavy oil and natural gas to make the electricity. So we think there are a lot of structural issues that will reduce and slow the advent of electric vehicles and them taking market share. So that platinum, palladium, rhodium will still be very important. Our expectation is that in 2050, half of the cars being made and sold will still be burning petroleum, either as petrol or diesel or in hybrid vehicles. So you're still going to need that platinum and palladium, rhodium. But for the near term, term, you've got a lot of investors who think differently, and they have problems with temporal spreads. So they've been bullish on platinum. They were bullish on palladium and rhodium. Now they've turned bearish, and they're probably going to stay bearish for a few years. But hopefully they won't dump a lot of metal into the market.